Hello, with me today I have Ian Heslop, who runs the Jupiter Merian North American Equity Fund, as well as a number of other mandates. Hello, Ian.
Hi Lee, nice to see you.
To begin with, could you just please give me a brief introduction to the fund and its investment strategy?
Sure. So I think the key point about North American equities in particular, but global equities as well, is the rotational nature of style returns. So we think that one individual way of investing works for a period of time, but can work for only a short period of time, and we need to rotate between styles. So the North American Fund is built on the idea of blending different styles together, and by styles I mean things like growth stocks, momentum stocks, value stocks, together within a portfolio that has the best opportunity to outperform the index consistently over a risk-adjusted return.
Okay, you've got significant exposure to technology in the fund, about 30% of the portfolio, and you own many of the familiar big tech names. Now, are you worried about valuation currently, or the wider macro situation, including inflation and potentially higher interest rates?
So yeah, I think to answer that in two parts. So first of all, the positional exposure we have within the fund is kind of reflective of the market we're investing in. The US market is very exposed to tech, as we all know. So when we're building portfolios, we have a very keen eye on reducing what we would call idiosyncratic risk, so risk to individual stock positions. And that drives the exposure we have to tech. So the tech exposure is around the exposure of the index. We're not trying to kind of overweight tech aggressively or underweight it. But to your question, I think there is a concern, which is kind of a more general concern really, that the North American market really has outperformed over the last few years, leading to that kind of valuation outperformance of other regions. Primarily, it could be argued, primarily due to the exposure to tech, because we've had a quality growth rally for many years, which is driven, as your question kind of points to, Lee, is driven by the idea we've had negligible inflation and we've had very low interest rates, which make long duration assets very attractive. So I think there is a concern as we move forward that inflation is likely to come back in one form or another, and the extremely low interest rates we've seen since the GFC up until last year, I think are unlikely to continue as we move forward. So yes, there is a concern about some of the valuation differentials within the North American market, particularly the large valuation differential that is seen in tech markets.
So at the moment, where are you finding the best opportunities?
So I think the kind of the interesting point at the moment, for me anyway, is that we have come off this period of quality growth, outperforming really strongly for the last sort of 10 years. And as I said at the start, it's probably to do with interest rate expectations that people have had and long duration assets looking more attractive in a low interest rate environment, hence growth companies outperforming. Value has kind of, the obituary for value investing has been written many times. I think value has struggled based upon that kind of interest rate environment. Going forward, I think it's a more nuanced argument. So one of the things that we've been doing within the portfolio recently is we've avoided value for many years. From around 2016, end of 2016 onwards, we've had very little cheap stocks in our portfolios. As we move forward, I think that's going to change. So we have been buying value since Q3 of last year. It does have to be timed. I'm not saying that cheaper stocks are now going to outperform versus growth stocks. I think there will be periods where both outperform, one outperforms or the other outperforms. But I do think that there is a higher likelihood of valuation of value stocks performing better, and that's reflected, as I say, in the portfolios.
Okay, you use various criteria to assess individual companies: stock price valuation, balance sheet, quality, growth statistics, efficient use of capital, and analyst sentiment and supportive market trends. I mean, is there one in that list which every company absolutely must score top marks for, or can you be flexible?
I think flexibility is the key to how we invest. So the simple answer is no. There isn't any one thing that dominates the portfolio, and that's deliberate because, as I said at the start, we're trying to recognise that nothing works all the time. There is a season for any investment strategy, value, growth, quality, momentum, etc., etc., etc. And we have to be diversified. We have to build all of those themes into the portfolio together. And then we can time on top of that. So we can move themes up or down in our portfolios. But any one theme isn't the key to outperformance. And so no one theme needs to be kind of the guardian of the portfolio that needs to have a positive outcome from the stock for the stock to be in a portfolio.
Okay, well, what's your top tip for someone wanting to invest in US equities?
I think it's always one of those questions where you are inherently likely to kind of bias the answer to how you invest. So I'm going to do that. I think it's the key point about North American equities, US equities, is how rotational they normally are. The last 10 years of quality growth outperformance is just very, very, very unusual. You have periods where value outperforms, you have periods where quality outperforms or growth outperforms. And I would say going forward, certainly, that ability to have multiple styles present and time those styles is likely to be the key to outperforming US equity markets, certainly for the next 5 to 10 years, I would say.
Okay, Ian Heslop, Jupiter Merian North American Equity Fund, thanks very much for joining me today.
Thank you.